Hello and welcome to Portfolio Matters, weekly update week 37 after a dramatic week in energy markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith.
Thank you, Richard. Right. First of all, some housekeeping. Just a reminder that Richard and I, various angel investors, and a lot of our participants on this podcast will be appearing at the Princess Louise pub in High Holborn on Wednesday, the 29th. And everyone is welcome. It would be great to meet our audience. So please come along.
Definitely.
Okay, this week's economic data. So we had some inflation numbers this week. German inflation came in hot. August number was 3.9%, above July, but meeting expectations. German wholesale prices came in at 12.3% in August, which is worrying. And that was above 11.3 in July, but slightly below consensus. US consumer inflation expectations continue to rise. They're now at 5.2%, and that should be worrying the Fed, although I don't think they're doing anything about it. So that rose again on the month. In the US, inflation came in at 5.3%, which was below July, but still strong and still way above the Fed's target of 2%. Core inflation fell to 4% from 4.3%, but again is still strong. And a reminder that we are expecting inflation to pick up again in the fourth quarter as rents start to rise. Now, retail sales in the US came in at 15.1% year on year, which was very good and unchanged from July, beating expectations. So US consumers are still spending. Now, in the UK, we had some earnings growth numbers, which were strong. So in July, UK weekly earnings growth year on year rose by 6.8%. And that was slightly down on June when it was 7.3%, but beat expectations. And including bonuses, it was 8.3%. So strong earnings growth. And the Bank of England concerned about inflation, wage growth will eventually lead through to inflation. So on that note, UK CPI came in at 3.2%, which was a massive leap on July's number of 2%. So it increased by 1.2% in a month. And as you will see, that has led to a sell-off in the UK government bond market with rising yields. And the core inflation rose to 3.1%. In China, industrial production year on year in August was 5.3%, which was down on July, but still pretty strong. Chinese retail sales, however, in August fell substantially and are now only up 2% year on year. And that's a big drop from July and a big consensus miss. In the EU, we had industrial production numbers for July, and that was 7.7%, which was down on June, but well above expectations, which is all good. And finally, EU car registrations. Now, we know that there's a great deal of disruption in the global car manufacturing industry because of this chip shortage, and Toyota, for example, have reduced their car production by 40%. And you can see that effect in the car registrations, which are down 19% year on year in August and continued the trend seen in July. We had quarterly EU wage growth, which was not very encouraging, frankly, and slightly contradicts the picture of strong EU growth because it fell 0.4% quarter on quarter in Q2, massively missing expectations. So expectations were for growth of 3.6%. Okay, let's go through some charts.
And so German inflation is continuing its rapid increase, and we don't actually know where this chart is going to stop, but it is clearly a significant change in trend, and the very ultra low interest rates in Germany, one would think can't be sustainable. And I think the population of Germany is very, very nervous of inflation. And so there will be huge social, political pressure to do something about this in Germany. It won't be acceptable. UK wage growth, well, this is a poor sign if you don't want inflation to go up, because wage growth at 8% year on year is highly inflationary. And we know there are various reasons. There's shortage of truck drivers, there's shortage of people to work in bars and so forth, and hospitality. So there's a lot of wage growth pressure around, and that will inevitably also feed through into prices that we pay. US inflation going the same way. There's the odd little tick down we're seeing, but fundamentally the trends that we're seeing at the moment are strong and sustainable. And the concern is that the news we're still getting in, and we'll cover some of it later, is that there is still a lot of price pressure in the system, which is yet to come through. US core inflation did tick down a little bit, but it has shot up enormously in the last 6 or 8 months. And US median CPI is on a powerful uptrend. I mean, the uptrend, actually, if you look at the chart, is similar to the one that we saw in 2017. And so it's not unprecedented as yet. The question is, with all the pressures we know that are in the system, is it going to continue to rise to a point where it is significantly greater than that which we've seen in recent history?
The other thing I'd add, Richard, is that median CPI inflation rose last month, whereas the headline numbers all fell.
Yes.
And the difference is that in the outliers. So one of the key drivers of very strong inflation in the US has been used car prices, and those fell last month, driving down CPI inflation, but they're outside the median, and the median price rose. So we're still seeing strong inflationary pressures.
UK CPI is, the announcement of CPI the other day was the largest increase, I think, since records began, the largest monthly increase in year-on-year CPI since records began in the mid-1990s. UK core CPI, again, all moving in the wrong direction, given that there is this huge pressure on central banks to keep interest rates low because of the highly indebted nature of our economies.
Yes, and you saw that Rishi Sunak was talking about the dangers to the UK fiscal balance of rising inflation. If we have a 1% rise in interest rates, he thought that would cost us £25 billion a year.
And this is a graph from the Financial Times showing how accurate the Bank of England economists are predicting future inflation levels. And the answer is they're not. Keith, they're awful.
No, absolutely. So what this chart shows you is the Bank of England's expected path for inflation at different periods. So if you look back, the red line is November 2020, and they're expecting inflation in late 21 to peak at like 2.1%. And they've continually revised it up. And then now, in August 2021, they're now forecasting it to peak above 4. But they haven't done anything.
Basically, they're trying to predict something which is inherently extraordinarily difficult to predict. And they are actually effectively their followers, because they take the last month's data and they extrapolate it in a way that produces the result they want it to produce.
Yeah, no, absolutely. But also, they haven't done anything. They've continually revised their inflation forecast to way above their target, and they've kept on printing money.
Yeah. and haven't raised interest rates.
Mm.
So, well, this is the same graph by a different group of economists, showing that everything's okay because inflation in the Eurozone will peak in Q4, and then it will come back down to 1%.
Yeah.
So no worries there. Keith.
So this is US continuing jobless claims, and we had a good week. This is weekly numbers, and continuing jobless claims continued to tick down, and they had quite a large tick down last week.
Yeah.
Okay, so moving on now. Our viewer from the US, Herman, sent me a very interesting piece this week on Norwegian oil consumption. Now, Norway has the highest penetration of electric vehicles in the world. So 64% of all new car registrations are electric vehicles. What has happened to Norway's oil consumption? Surely it must have gone down. Well, it ain't. The dark blue line is the electric vehicles share of new car sales, and the yellow line is Norway's oil consumption. And you can see that the increase in electric vehicle sales has had absolutely no effect on Norway's oil consumption. Now, why not? Well, first of all, cars are only 20 to 25% of oil demand. The car fleet turns over slowly. So although 64% of new cars in Norway are electric vehicles, they represent less than 10% of cars on Norwegian roads. In addition, the car fleet has continued to rise, and actually it's risen really quite substantially. In 2011, there were 2.3 million cars on the road, and there are now 2.8. So that's a 20% rise in a decade, which is astonishing, actually. Also, number of diesel vehicles has increased. So the number of vans on the road has increased by 15% since 2011. And the other thing is there's been a big rise in petrochemical demand. So LNG and ethane, which are used to make plastics, etc., they've seen a 31% rise in consumption over the past decade. And all of that has offset the fall in gasoline. And if you look at the numbers, so this is oil consumption by product over the last decade, you'll see motor gasoline demand has fallen, and it's fallen quite substantially. It's fallen by about a third. But when you look at total oil consumption, it's totally unchanged. And in fact, you look further at the 2020 numbers, you would have expected oil consumption in Norway to have dipped substantially last year, as it did elsewhere in the world. And in particular, if you look at the jet and kerosene line, you saw more than a 50% drop in jet fuel demand, but total oil demand was unchanged because there was a rise in other gas oil consumption, which I presume must be going into petrochemicals or something. Okay, moving on to other charts that caught our eye this week. So this is the number of UK workers, and this was a chart from the ONS, and it shows that number of people in employment is now above pre-pandemic levels, which is great. But they're not working as long hours as they were. So the UK economy still has some way to go to get back to normality. But just like in the US, the number of job vacancies has continued to surge. And so that is a very positive sign for the UK. And these are the headline indicators of the UK labour market. And see that we've got 75% employment, which is actually pretty good. Unemployment is ticking down, and it's 4.6%, which is still elevated, but not huge. But the number of economically inactive people is really substantial. I think a lot of those will be students, but also the big question is, have a lot of people left the labour market?
So this is a graph showing the amount of US savings deposits at commercial banks, and it's enormous. and it's spiked up very recently, but it's been on this another exponential growth curve actually since the 1980s by the look of it. And now there's a huge amount of US dollars sitting in these savings accounts. But one would say if this lot comes out, then the economy is going to be red hot. But it is not coming out. It is continuing to be saved, despite very low interest rates.
Yeah, but we have seen in previous weeklies that lots of charts showing that claiming to show that the build-up in savings during the COVID recession have all been spent. And this chart would seem to absolutely contradict that. And we've just seen that US retail sales rose 15% year on year. And it seems that, people got money.
The US PPI inflation is above 10%. So this is the inflation rate experienced by manufacturers for their inputs, and that's extraordinary. And that is not reflected in the inflation rates as yet that consumers are experiencing. But it's difficult to think that, given the rate of increase and the continued increase, that this isn't going to continue to add inflationary pressure to CPI. And bond yields will continue to drop because everything's hunky-dory or something. I listed this chart defies explanation apart from the fact that yields are being artificially repressed by central banks.
Or bond buyers really believe that inflation will be transitory. And while we're talking about inflation, just a reminder of how much money has been printed. So this is actually the fiscal stimulus. So how much money the US government has borrowed. But remember, the Fed has printed half of it. So comparing the federal stimulus packages per capita between the COVID stimulus, the Great Recession, and the New Deal back in the 30s, which got us out of the Great Depression. And remember, the Great Depression was a long period. It's like 1929 to 37. The COVID stimulus is obviously twice the size of the previous biggest package. No wonder we're getting inflation. This is not difficult. And as a result, you'll see that inflation is picking up in the US faster than anywhere else because the US has printed more money. It's as simple as that. And German wholesale inflation is at 12.3%. And eventually, as Richard's just said, that will feed through. Either you're going to have collapsing profit margins, corporate profit margins, because they're going to absorb the costs, or they're going to pass it on to consumers, in which case inflation continues to rise.
Ultimately, Keith, the profit margins can only drop so far and businesses become unviable, because if they've got any debt to service, any principal repayments to make, profit margins fall too much, then they default on their debt. So I don't know, given how indebted the corporate world is, I actually don't know how much margin of safety businesses have in order to take margin compression.
Well, profit margins are very high in the tech sector, but elsewhere they're not. They're more normal levels. But also, Richard, we know that the lack of enforcement of competition policy over the last 2 decades has led to many industries actually being oligopolistic, with just a few players and that means that there's reduced competition and they do have the power to raise prices. So I fully expect them to pass all those price rises on to consumers.
Yeah, I do too. German inflation expectations are not looking happy, are they either? I mean, this comes back to the point I was making earlier, which is that the German population is hypersensitive to inflation, and this is not looking comfortable for the German politicians and the ECB.
And we know the Germans have been buying lots of gold. But
yes, we do.
Not enough of it, not enough to keep the gold price rising, sadly.
German electricity prices have a fantastic graph. Well, depending on which side of the curve you're on. But we've seen a lot of these graphs recently do this and then drop back down very rapidly. So that there's a significant possibility that it may come back down sort of 70 over the next week. But these spikes, actually, what they across the board, they're indicating quite an unstable system, I think.
Yeah,
which is more concerning.
Absolutely. I would say that these prices are absolutely unsustainable. I mean, you can't go from this is the price of energy, go from 40 euros to 100 in the course of a few months, and it not have an enormous effect on corporate profitability.
Yeah,
but you're
and other consequences.
Right,
I was going to say, and other consequences which actually you can't determine. You don't know what they're going to be until they arise. Social unrest, or the problem with this huge instability that we appear to have now is that there will be there are unforetellable consequences.
So, but you're absolutely right about the instability. Where the more renewables we have in the grid, the more volatile the electricity flowing into the grid is, because if the wind doesn't blow and the sun doesn't shine, suddenly you have no electricity. And that's what's happened over the last week in Europe. And then we also have this gas crunch, and there's been a scramble for get the coal-fired power stations back online, basically. And this is the UK, and astonishingly high electricity prices. And we have seen a couple of domestic electricity companies, so companies that provide electricity to households, go bust. And they had sold electricity to households at X, and then were having to buy it from the grid at Y.
Yeah, well, a mismatch, haven't they? And I think this one is the news that two major fertilizer companies in the UK have suspended production indefinitely because the price of natural gas has gone up so much that it makes their production of fertilizers, natural gas being the feedstock for the fertilizer production, makes it unviable, economically unviable.
And we had an interesting comment from a farmer, Hugh, on our comments section of the podcast, saying that if he couldn't get the fertilizer, he couldn't sow his crops, and he was finding it difficult to source fertilizer.
And then that leads to price increases, food price increases. There is it's a little bit like a flood coming down a stream, isn't it? At the top end, you see the water level is a bit raised. At the bottom end, it spreads across the land.
Yeah.
And so we've got this price pressure at the top end, and then it just, you can't say it's only going to affect this, it's only going to affect that. Ultimately, it spreads everywhere.
Well, the thing is, Richard, when we go through this, everywhere we are seeing price pressures, frankly. And this, so just looking at this chart here, supply chain disruptions continue. So these are bottlenecks outside US ports, and basically the bottlenecks are growing. So you're getting continued supply chain disruption. So you're getting reduced supply, and you've got very high demand. And everywhere you look, as we go through this charts, you're seeing price pressures, and central banks can continue to expect these to be transient, and bond buyers seem to believe them. Now, what happens when bond buyers cease to believe them? And these are disruptions outside US ports, 3 US ports. You can see that it's not just confined to the West Coast, it's everywhere. So as a result, shipping costs are going through the roof. And also, as shipping is disrupted and prices are sky high, so people are going to air freight, and air freight rates are now going through the roof. Are you seeing inflation everywhere? I am.
Yes, I think we are.
So, but at least the pace of central bank bond purchases is slowing. They're still doing loads of it. They're doing 0.2 trillion less than they were last quarter.
Yes, this is showing the low blue collar workers' pay increases are the high skill workers' pay increases have plateaued over the last 5 years, whereas the low skilled, which is the white, low skilled pay increases are continuing, which means that low skilled workers are catching up with the high skilled workers, which is good for reversing inequalities in society.
And the fear and greed index. Well, one of the things that's puzzled us is how this raging bull market has been accompanied actually by quite a lot of anxiety. And so the CNN fear and greed index, which looks at the price of, amongst other things, puts and protection, shows that the price of protection is high. Investors are fearful. Okay, quickly talking about COVID. So, good news in the US, COVID cases appear to have peaked. But in the UK, Scotland saw an enormous rise in cases when schools reopened. And in England and Wales, schools have just reopened. So they went back to school last week, and you'd expect to see cases start to rise 10 days after they went back to school. And this is the current state of affairs. And let's see what happens. But when you look at total deaths in the UK, they're now within their normal range. So that's good.
That's an interesting graph, isn't it? And this one shows that the UK daily death rate is basically hasn't gone up with the case numbers, whereas in the US, the death rate does appear to be going up with the case numbers.
Yes. So we've been much more effective with the vaccination than they have.
Yeah. So the equity markets didn't do very much this week, actually. The FTSE down 0.4%, Stocks Europe down 600, down 0.4%, S&P down 0.4%, the Nasdaq down 0.4%, Topics up 0.3%, Bitcoin up nearly 3.5%, and the GBP US dollar slightly down on the week. So a quiet week in the markets, Keith, ostensibly.
Yeah. But masking lots of stuff going on, actually, big movements in commodities, and we'll show you that in a minute. I think this is a very interesting chart. It shows the S&P 500 EPS expectations, so earnings per share expectations and you'll see that analysts are expecting very substantial earnings growth next year, best part of 10%. But all the charts we've just shown you show that there are increasing price pressures on inputs for industrial companies and companies that make things, service companies. So will margins be squeezed? So investors don't seem to have adjusted their earnings expectations down in any way. The full year 2022 earnings expectations continue to rise.
Yeah.
And this is charts showing data from a survey of investors. And what it shows is that the light blue line is the number of investors expecting a stronger economy over the coming year, and that's been plummeting. But they haven't changed their weighting to equity in any way. So if they start to adjust their equity weightings down in line with their expectations, you would expect equity markets to fall. Now,
the dividend yield on the S&P has crashed. Now, a lot of S&P companies do share buybacks these days, don't they, as a substitute for dividends. And obviously, as the price of the S&P goes up, if they don't increase their dividends, then the dividend yield will also crash. But given that the earnings per share, the profit level of profitability of these companies has gone up substantially, it's intriguing that the dividend yield is actually plummeting. And I think share buybacks are continuing, aren't they, Keith? There's no real let up in the pace of share buybacks.
No, they're coming back. So what this is showing is the last chart showed us that the dividend yield in the S&P 500 has fallen. And this chart shows that actually companies can now afford to start hiking the dividends again. So the dark blue line is net income, and the tan line is dividends plus buybacks. So you'll see dividends plus buybacks has collapsed, but actually a big gap has opened up between that and net income. So you'd expect US companies to start hiking their dividend, which would be bullish. Okay, going through industrial commodities, and it was a dramatic week in the commodity space. So aluminium continued to rise, up 1.8%. Cobalt was flat. Copper has been stable, up 0.4% on the week. Chromium continued its slightly mystifying run upwards. Iron ore's been coming off, but chromium's been going up. And on that note, iron ore had a terrible week, down 12.4%. Lithium was flat. Neodymium was up a touch. Nickel came off, down 3.5%. Tin continued its run, up 1.7%. Ferrovanadium fell 6.7%, following iron down, which is what you would expect. Yes. Now, in energy markets, we saw that there have been these enormous spikes in the price of natural gas in Europe. And we did a special talk during the week, which I hope you all watched, on the gas crunch. And that is all linked to reduced supplies from Russia. And this week, from the fact the wind didn't blow, so having to fire up gas and coal power stations to fill in the gap. And the rise in natural gas prices during the week seems to have dragged up the price of other fossil fuels, as investors have become aware that the lack of investment in fossil fuel production is leading to shortages. So WTI was up 5% on the week. Natural gas, European natural gas, was up 11%. And coal was down 0.8%, but remains very elevated. And finally, uranium had an absolutely astonishing week, up 23%. And Richard will discuss that in a minute. So this is crude, and as the crude price has risen, so China has released stocks from its strategic reserves in order to stop the price rising too quickly. But ultimately, it's going to have to restock. Okay, so some charts on oil. And this is a table showing crude production and spare capacity for the 13 members of OPEC plus Russia. Now, what is interesting is that there's a big difference between what the reported official capacity is, which is the column second from the end, and what Bernstein are estimating their actual spare capacity is. And in particular, there are 6 members of OPEC who don't have any spare capacity at all, such as Nigeria, Libya, and Angola. And actually only the main top 5, so Saudi Arabia, Iraq, UAE, Iran, and Kuwait, actually have any spare capacity. So the market is expecting the oil market to be well supplied over the next year, but how much spare capacity is there? And this is data from the EIA showing that next year they're expecting supply to exceed demand, but OPEC are forecasting demand to be where the red dot is, whereas the EIA is forecasting demand to follow this yellow line. So the OPEC are forecasting that already in Q4, oil demand will be back to the best part of 100 million barrels a day, and that is bullish. So there are a lot of conflicting forecasts at the moment. Meanwhile, in the US, crude inventories continue to fall, and the bottom right chart shows total inventories and the lowest level they've been since 2015. And meanwhile, the decline rate of existing oil fields has been accelerating. So we need to keep on investing in oil production in order to get the oil we need. Otherwise, you're going to see a price spike in the oil price. And while we're talking about energy, this chart here shows the materials required to build various different forms of power. And you'll see solar PV requires an enormous amount of steel, glass, concrete, and specialty metals. Hydro, obviously, you just need to build a dam that is mainly concrete. But bottom line is, they are all very resource intensive. And for example, making concrete requires vast quantities of natural gas.
The aluminium is continuing to sit right at the top of its recent very rapid price increase. And copper is continuing to consolidate at around about the $4 a pound, $4.2 a pound level, which suggests a degree of stability actually in the market, that it's been doing that for the best part of 4 months now. Chromium, as Keith mentioned earlier, has gone up substantially, but we don't really understand why. It's a key component of specialist steels. And as we know, the steel production in China is off by 15%. So it's a little bit unclear as to why that price is going up. Iron ore has come back down to where it was a year ago. And it looks very much like the lumber chart in terms of what it's done. The question is, well, we never really understood why it went up in the first place to the extent that it did. And presumably it was actually speculative mania, which is now, speculative froth at least, which has now come out of the price. Be interesting to see where it goes from here. And this is a graph showing the massive reduction in China crude steel production, which of course has reduced significantly the demand for iron ore, which will have reduced the price. And then we have the ferroalloy, ferrovanadium. So I'll just go back to the ferrovanadium price. That is also reflective of this reduction in Chinese steel production, I think.
Yeah. Nickel,
actually, although it was down a few percent this week, it isn't doing anything other than sustaining its sort of sawtooth uptrend. Tin is just stabilizing itself around $34,000 a ton. Ferrovanadium, as we discussed. Dutch natural gas, I think. Keith, you want to just talk about this?
Well, we did the special during the week, but the gas prices squeezed up to, was that 78 euros, and have since come off. Now, the price remains very elevated, but medium term, we're back in the start of the year. You were talking about a price of around 40. So even at these levels, you have the price is 50% above where it was at the start of the year. And it's just, those are massive costs going through to industry and heating homes and electricity prices. And so, if it stays at this level, you are going to see big cost push inflation in the Eurozone. And in the UK, the picture is even worse, because the marginal supply for natural gas comes from Russia, and it goes through Europe, and then it comes to us. And if Europe is going to be short of natural gas this winter, you do wonder whether they're going to restrict supply to the UK. So UK natural gas, we obviously have a great deal of renewables in our electricity generation mix, and the wind didn't blow. So, we needed to get hold of some scarce natural gas to generate electricity.
I mean, we have a problem with that. If there is a supply squeeze on natural gas in the UK over the winter, we have a real problem because people use it to heat their homes. We use it for generating electricity, which means you can't actually substitute your electric fan heater for your gas central heating or vice versa. And I suspect the government behind the scenes will be doing everything it can to import as much liquefied natural gas as can be stored in the UK right now. Certainly I would be doing that because I would be very fearful of a supply crunch in natural gas over this winter. And it just shows how exposed the UK economy is to the rest of the world's energy situation.
Yes, well, the thing is, Richard, we run a just-in-time system in the UK. We actually have relatively little gas storage.
Yeah.
And I suspect if push comes to shove, we will be firing up the old coal-fired power stations to generate electricity. And as a result of all this, the price of natural gas in the continent is double the equivalent price of crude. So if you can burn crude, it would be economically sensible to do so. So, and also just tends to show that this Dutch gas price is just unsustainable.
There is an ESG issue here, isn't there, as well?
Yes, but I strongly suspect when it comes to, sitting freezing in your kitchen or burning some coal, people are going to burn some coal, frankly.
I think you're right, Keith. Speaking of coal, the coal price has steadied at this massive peak. It's tripled since in the last 18 months or so, and it's stabilized. And you would be surprised if it dropped right now, given the supply crunch in gas.
Absolutely.
And that coal is a substitute for gas. Uranium. So we talked last week about the uranium squeeze by the Sprott physical uranium ETF, and that has been taking uranium off the spot market. And then the other day, there was the announcement that the US, Australia, and the UK were going to build a fleet. We're going to assist Australia to build a fleet of nuclear submarines as part of the defense against Chinese military buildup. And I think the uranium price was then further boosted by this announcement, which clearly indicates demand for uranium in whatever size the fleet of Australian nuclear reactors will be, but also the comment that I read this morning that there is no country in the world that has a nuclear submarine fleet that does not have a civil nuclear power generation program. And Australia does not currently have civil nuclear power. So that strongly suggests that there will also be demand for Australian civil nuclear power. So all of these things have combined to boot the price of uranium up 23% this week.
Well, I'd also add, Richard, that I think the dynamics of this Sprott uranium is an ETF.
Yes.
They are, so they're buying uranium in the spot market and then essentially taking it off market and storing it, driving the price up. And that gets in more investors, and you get this feedback loop. So
I suspect the price of uranium. I mean, it went in. Well, where are we now? Like 15 years ago, I think it was up at around $120 a pound. I wouldn't be surprised if, as the course of this squeeze, it went up to that level. I also think you need to be really nimble if you have uranium companies, miners. I think you need to watch them very closely.
Yeah. Okay, on to precious metals, and it was frankly a very poor week. Gold down 2%, silver down 5%, platinum down 4%, rhodium down 32%, palladium down 8%. And let's take you through some charts. So gold was, although it's down 2% on the week, it's within its recent trading range. But given inflation is picking up and interest rates are very strongly negative in real terms, the performance of gold has been rather disappointing. Silver has got to the bottom of its recent trading range. Richard, any thoughts?
There was a lot of speculation went in with Robin Hooders, wasn't there?
Yes, that's true.
Who did that squeeze, which has sort of come out. Very difficult to say, I think, Keith.
No, you make a very good point about Robin Hood is all buying it, and you wonder actually if they're now tiring and selling it again.
Yeah.
Platinum had a poor week. Rhodium had an absolutely appalling week. And we recently did an update on our analysis of Sylvania Platinum, where we talked about this. And our conclusion was that the range in the prices of rhodium between 5,000 and 30,000 over the course of the last couple of years meant that you had very little idea where fair value was. And that has proved to be absolutely right. So it's falling, and we still don't know. This could go right back to 5,000 and below. We know that global car manufacturers have cut their production, and rhodium supply is actually slightly elevated this year. So in the short term, car manufacturers will have cut their demand and supply is high. So this could go lower. And palladium is also used in catalysts, and it also had a very poor week. Right, on to yield rates, and you'll see that in the UK, we had rate rises across the curve. So the 5-year is now at a best part of 0.5%, and the 30-year rose 6 basis points on the week and is now firmly above 1%. But then bear in mind, we've had an inflation print of 3.1% this month. And in the Eurozone, bond yields also ticked up. Now, if we look at the chart of the UK 10-year gilt, you'll see that it started rising again, and it seems to have momentum. So is that the beginning of rates starting to normalize and move towards the inflation print? And obviously, with the high levels of global indebtedness, rising interest rates will start to have economic side effects. But in the US, yields actually were quiescent. And finally, the seasonality chart. And we're moving into a dangerous part of the year.
We are. And I think last week we actually sort of followed it, didn't we, Keith? Roughly speaking, down 0.4.
Yeah.
Mid-September. Okay. So
hold on to your hats. Right, Richard, what were you up to this week?
So this week has been one of what I like to think of as masterful inactivity, but most people would probably say foolish inactivity. So I've done nothing this week. I did nothing last week. My portfolio is down 0.2%. My gold mining shares got a somewhat hit, but my shares in my investments in oil and gas did reasonably well and basically balanced the whole thing out. And it's depressing, isn't it, when you have a share that does particularly well and you have another one that does particularly badly, and the net result is a small negative. So nothing for me to report here, Keith. A quiet week, and I'm trying, as I said before, I'm trying not to trade too much. You know, I'm still fairly comfortable where I am, and I'm just leaving things.
Well, you've done very well on the year, Richard. You're up 10.3%. So, you know, and we know that the more trading you do, the higher your costs are. So I think that's a very sensible strategy.
No, that's true, Keith. Yes, thanks. How about you? How did you do this week?
Okay, I had a good week. Regular viewers will know that I have a very large weighting in oil and gas. And the share price of oil companies started to move, as I think the spike in natural gas prices has made investors aware once again that the lack of investment in oil and gas could well lead to shortages. And we're already seeing shortages in gas and coal. And to my mind, it's only a question of time before that spreads to oil. So I was up 2.3% on the week, which takes me to 4.5% on the year. Now, still massively underperforming the all share, Richard and Stuart, but closing the gap slightly.
I also think, Keith, that there is some sort of hysteresis effect with the shares of oil companies, in that the oil price, it did fall a bit and people got a bit nervous, but it didn't fall very far, and it's now come back up to above $70 a barrel. At some point, investors are going to start looking at the profits these oil companies and gas companies are throwing off and think this is too good to miss out on. And so I think your thesis is completely valid. I just think that the timing hasn't been quite as we would have expected it to be.
No, absolutely. Well, the thing is, Richard, I actually had a long conversation with one of our American viewers, Herman, yesterday. And I was articulating why I had such a large holding in oil and gas. And basically, it's because it's the only thing I think I know. So when we talk about technology stocks and the outlook for interest rates and inflation, there's so much uncertainty. And if interest rates start to rise, then you're going to have all sorts of economic knock-on effects, which are going to be very difficult to predict. But the one thing I know is we're going to still need oil for a long period, and we've been cutting investment in it. And so if inflation starts to pick up, who knows what will happen to lots of other financial instruments, but there's still going to be demand for oil. So hence I've got a lot of oil. Okay, so I sold some BP during the week because I need to free up some cash, having made a very disappointing return of 8%. Bear in mind, I bought that during 2020 when the price had completely collapsed, and it's recovered a bit, but nowhere near as much as I expected to. And I had a tiny position in a silver miner, Alien Metals, an explorer, and I've cleared up the portfolio and got rid of it. So what did I buy? Well, I bought more Serica, and regular viewers will know that that is a North Sea gas producer. And I bought some Harbour Energy, again, adding to a position. Now, Harbour Energy also have about 50% gas in their portfolio, and their share price has fallen because in the last interims, the production guidance was disappointing, but a lot of that is due to maintenance, and the supply should revert to normal in the fourth quarter onwards, and their Tolmount gas field is due to come online in Q4 into very elevated UK gas prices. So here's hoping. And this is the share price of Serica Energy, and I'm glad to say I bought it before this recent 10% spike in the share price.
Very good, Keith.
And we will be doing a share talk on Serica, and I'll try and get that done as soon as we can before the share price goes to the moon. And this is share price of Harbour Energy, which has not followed it. So, okay, I think that's us done for the week. Thank you all for watching. I hope you'll press like and subscribe to the channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.